Good morning, Susan. How are you today?
Good morning.
So, everybody, welcome. I'm Maureen Campiola. I'm the marketing director for Your Key to Senior Living Auctions, and unfortunately, Lisa couldn't be here with us today. But I want to welcome Susan Woolfe, who is going to explain to us about uh, life and viatical settlements. I think I got that right.
Very good. Very good. You
I'm
got
looking
it.
forward, yeah, I'm looking forward to learning about this. I find this topic really, really interesting. And so you can take it away, Susan, and tell us all about it.
All righty then. Just let me. Okay, it says host disabled attendee screen sharing.
Oops, hold on.
I know everybody wants to look at my beach scene. I'm not really at the beach, just a disclaimer here. I just am dreaming about it. So,
Reading about it. You should be able to share now, Susan. Sorry about that.
okay, I'll get out of that. Okay. Okay, so everybody see the first screen, Life and Viatical Settlements 101?
Yes, we can see it.
Okay, well, to answer Maureen's question about this, basically, I'm a financial advisor and I do work with life insurance and numerous other products, but they're specialty products for the most part. And if you happen to buy a life insurance policy or someone you know owns a life insurance policy that they bought in the past, usually people try to buy them at younger ages, but not always. But isn't it nice to know that when you're old, which by the way, 80 is the new middle age, so I don't know anybody's age, but you can potentially have it bought back from you when you're older if you just don't need it anymore. So we're going to jump right in and learn a little bit more about that. And I'm not able to move my slide for some reason. Let's see what happens if I go this way. There we go. Okay, so you know the old saying, you can't see the forest for the trees. Well, we want you to see the forest and the trees in the forest. So life settlements we call an asset that's been hidden from view because your life insurance policy has value before death. And over the years, people have complained, you know, to me from time to time, well, gee, you know, I want my family protected, but I hate that I get nothing out of this, you know, nothing happens until I die. Well, that is not necessarily the case. So I'd like to start by telling you a little story, giving you a little bit of history. And the history of the viatical settlement, which by the way, viatical, if you're Catholic, you might know the term viaticum, which is basically about giving someone their last rites. They're very close to death. So that's where the term viatical came from. But life settlements are a little bit different in that you don't have to be close to death in order to have a cash settlement for life insurance. But the history of the viatical settlement can be traced back to the early 20th century, meaning about 1911, when there was a Supreme Court decision about life settlements. In 1911, Supreme Court Justice Oliver Wendell Holmes Jr. delivered a decision in a court case known as Grigsby versus Russell. That is what established a life insurance policy as an asset that can be sold, because just like a car or a house or stocks, those are assets that can be sold. Well, so is a life insurance policy. The story goes that Dr. Grigsby agreed to perform an operation for one of his patients who, when he was told he needed this operation, he said to the doctor, well, I would like to have the operation, but I don't have the money. And the operation at the time cost $100. So that's inflation for you. But he did say that he would sell his life insurance policy to the doctor for $100 plus the assumption of payment for any remaining premiums on the policy. And then Dr. Grigsby, in turn, would become the owner and the sole beneficiary of that policy. So Mr. Burchard was his name. When Mr. Burchard died later, not related to the surgery, Dr. Grigsby attempted to collect the death benefit from the insurance company. Well, the insurance company said, well, what's your insurable interest to the deceased? We don't see an insurable interest. You're not a relative. You're not a business partner. So there was a bit of a battle that had to ensue because of this, because by rights, you know, he was the person who should receive the tax-free death benefit. Well, it went to the Supreme Court, as I said. They ruled that, like any other asset, the owner of a policy has the right to sell the policy to a third party. Thus, the first Viatical case was completed in 1911. Now, you may recall that AIDS came about in the 80s, and at the first, nobody knew what was going on, but a lot of people were sick for long periods of time before they passed on, and they needed help, financial help. So Viaticals really kicked in a big way back in the 80s. So they've been around for quite some time. So let's move on to the next slide. There was a study from the National Institute on Retirement Security that confirmed many Americans are ill prepared for retirement, and they're actually highly anxious about their ability to retire at all. And the three single largest concerns of older Americans, of course, healthcare is one, 49%. Losing their independence comes right behind at 41%. Changes in Medicare, which has changed and can change some more, 38%. And of course, the number one concern is running out of money too soon. And Wells Fargo ran a survey that concluded that a large majority of Americans in the middle class said they would rather die early than not have enough money during retirement, because you want your retirement to be comfortable, right? So what can you do about this? Or, you know, how can we work together? Sometimes people don't have life insurance, or they have very little life insurance, maybe what we call a final expense policy just for funeral expenses of $10,000 or $20,000. Those don't really come into play with life settlements. They need to be in the realm of 100,000 or more. There are a few exceptions, but they're rather rare. But basically, American seniors own about 38 million life insurance policies with a total death benefit of more than $3 trillion. However, today, nearly 88% of what's called universal life policies and almost 85% of term life policies never actually result in a death claim. Well, why is that? Well, term insurance, you may know, is for a period or a term of time, and then the policy either goes away completely or the premiums skyrocket. So a lot of times people, it's very affordable in the early years. People will buy it to cover a mortgage. If they pass away early and they need a mortgage to be paid off so their family has the place to live mortgage free, they might buy a 30 or a 20-year term policy to cover that, with plans that the mortgage will be paid off by the time the policy goes away or the premium goes too high to handle. So one example is a premium that's just $1,000 a year, jumping after 20 or 30 years to $30,000 a year. That's untenable for most people. They have to drop it, but yet they paid all these premiums for those years, and then it's gone. So you could use the analogy, you know, buying a home and building equity is a better way to go than renting an apartment for the next 30 years. You know, at the end of each year, the landlord has the right to raise the rent, and they may or may not do that. But if you live there for 30 years and you leave, you have nothing to show for it. However, if you own a home, you can build equity and own it free and clear after a period of time, whatever the mortgage is. Now, the other interesting thing is the statistics I saw most recently say, and again, statistics, I think can be manipulated here and there, but this statistic that I saw said that term policies only ever pay a death benefit less than 1% of the time, because over 99% of the people who have term policies outlive the policy. Universal life is said to be a blend of term and permanent, and they can be set up in many different ways. Some are better than others. Some implode after a period of time. We won't talk about that today, but the point is, it can be any type of policy is potentially eligible to be sold. Now, people do protect themselves with life insurance in case the unthinkable happens. It's really about peace of mind. But, things change. If you're a business owner and you sell your business, you retire, and you bought that policy to protect the business, you don't need it anymore. Most people think that they should just cash it in for the cash value if there is any. So let's say there's $50,000 in cash value, they surrender the policy, they get the cash and move on. But what if I told you with a life settlement, they can get up to 8 times more than that cash value if they qualify? So, it never hurts to try. It's free. And that's why it says, there's a free non-binding appraisal. So if someone has a policy that they want to check to see if this is a viable solution to their situation, I have about 14 questions that I ask to filter to see if they're a good candidate and the policy is a good candidate. So what we're saying is, rather than all these people, which is staggering numbers, more than 250,000 policies with a combined face amount or death benefit total of $57 billion are lapsed or surrendered back to the life insurance companies each year. Well, what does this mean? It means it's a cash cow for the life insurance companies if all these people have paid premiums for many, many years, and then they just surrender the policy and there's no more death benefit. So that leaves the company off the hook for paying any death benefits for these policies. Now, the average face value of these policies is $225,000. And keep in mind that the figures only are including universal and variable life policies. When we add the term type of life insurance and whole life policies, the equation total jumps to $112 billion lost. Staggering. So what options do currently exist to exit a life policy and get something for it potentially? Some people maintain a policy by using the cash as a loan to keep paying the premiums. That can be done with policies that have built up some cash value. They can apply for an accelerated death benefit if they have a chronic or critical illness. Many of the companies came out with free add-on or rider to the policy in the 80s when AIDS came about on the scene, to say, you can use up to, for example, 75% of your death benefit before you die, and then the remainder will go to your beneficiary. So that gives people a little dignity. They can pay their bills if they can use the death benefit to some extent before they die, if they're very ill. Also, a policy can be assigned to a third party as a gift. A nonprofit, a 501c3. If your favorite charity needs help, then I can tell you here in Florida, in Jacksonville, where the Episcopalian diocese is located, they have been operating off of gifted life insurance money in a large way since the 1930s. So it can be very huge for the receiver when it comes to gifting all or part of a life insurance policy. Now, term insurance sometimes is convertible to a permanent type of insurance, sometimes not. If there's a conversion privilege, it would be listed in the contract, which is the policy. And to convert to permanent, there's usually a time limit. So the time limit varies based on when you got the policy and the parameters that the company put out. Oftentimes, or most of the time, it's by no later than age 65. You could also reduce the face amount or the death benefit to make your premiums more affordable. Sometimes people bought $1 million policy and they have no more debt, and they say, you know, $500,000 or $250,000 will be more than enough at this point in my life to pass on to family members. Also, and finally, is selling of the policy to a third-party investor group, and that is what we're talking about, the life settlement market. So why even explore this? Well, the government, they have a GAO report. They said a typical senior realizes a settlement on average of 7 times greater than the policy cash value. So that's huge. Like I said earlier, if your cash value in a permanent policy happens to be $50,000, well, wouldn't you rather have $350,000? Sure. You know, for every $1,000 they would have received by surrendering a policy, the money they received via the life settlement would be $7,000. So I can tell you that the cases that I've worked on in the last couple of years, even when the policy has just exploded in cost and been essentially not a very good policy, in my opinion, sometimes people can get a couple of $1,000s back, which is better than nothing. If they were to lapse the policy and get nothing, isn't it better to put some cash back in your pocket if you can? Now, another study by Insurance Studies Institute concluded that of 90% of the seniors they surveyed who had actually lapsed their policy, they would have considered a life settlement if only someone had told them that this existed. So, you know, even if you don't have life insurance or this is not of interest, you may know somebody or you may run across somebody when you're at an event, chatting with friends, family, neighbors. Maybe somebody's in trouble with a situation, an illness, or even job loss. As we know, things are a little bit out of the ordinary these days, and people are looking for any help they can get. So this exists. It's a viable solution for many people. It's a real game changer and lifesaver sometimes. So a lot of financial professionals are actually themselves unaware that this exists. And if they are what's called captive with a company, and a company does not offer life settlements, sometimes they actually forbid their employees from offering it as a solution. And this has gone to court a few times in past history, because that's not letting the person, you know, exercise their fiduciary responsibilities in helping clients. So one study found that 49% of financial professionals lack the knowledge about life settlements, and as a result, almost never recommend the option, because even if they've heard of it, they don't understand it. And what is worse, 23% said they were prohibited from engaging in a life settlement transaction by their insurance company. Well, you know, the life insurance companies do not like it when life settlement representatives call and send the paperwork that shows that they are taking over ownership of the policy as per the client. So they sometimes dawdle, they drag their feet in doing the paperwork, and that's not a good practice, but it does happen, and hopefully it will not be happening in the future. So why is it the right thing to do? And I'll go back to the Supreme Court case that Justice Oliver Wendell Holmes Jr. wrote about in his opinion in 1911. So far as reasonable safety permits, he said, it is desirable to give life policies the ordinary characteristics of property, and to deny the right to sell the policy except to persons having such an interest is to diminish appreciably the value of the contract in the owner's hands. So the conclusion, of course, is that life insurance is in fact your private property. So therefore it can be assigned or sold at the will of the owner anytime for their own personal reasons. So now in 1996, we all know HIPAA because we've chopped down a lot more trees for more paper work for HIPAA. It allowed the owner and beneficiary to transfer the ownership and or beneficial interest in that policy to a third party. So this is out there and well known in certain arenas, but not many. So I want to give you some examples. I have some real life recent examples, and I'm going to give you some to kind of show the full range or realm of situations that people can help themselves with a life settlement. So this is a fiduciary duty example. As you or this person is about to retire and has the $1 million term life policy, which, term is not permanent. It goes for a period of time and then either goes up astronomically. It may last to age 95, by the way, but that's with premiums going up every year. They're just launched into space. They're so high. Nobody can afford them. But if you were on your deathbed and you owed a $50,000 premium for one more year, you would probably scramble, take a loan out somewhere, do whatever it takes to keep that policy so that it pays the $1 million. But, for a lot of reasons, you've concluded maybe that you no longer need or can afford to maintain the insurance coverage, especially, going into retirement. So you tell your life insurance agent your predicament, and this now financial services advisor says that upon the express directive of his insurance carrier or his broker dealer, your financial advisor intentionally fails to tell you that there are life settlement providers that could be willing to pay you as much as $200,000 to purchase this policy. And because this is withheld, you simply allow your policy to lapse. You see no other way. How would you feel? Would you feel that the financial advisor and his or her broker dealer had breached an obligation to you, the client, to disclose certain material benefits associated with your policy? And then that was a direct loss of $200,000 to you. The second scenario, your business has a $5 million policy on your life, and it had been required by the bank. And that's very common in business. Now the business is being sold, so you determine you no longer want to continue paying the premiums. Moreover, your health has deteriorated and you can no longer purchase insurance with the same rate class. Sometimes people want to purchase insurance and they are not insurable, but if the rate class is higher, the premiums can be substantially higher. So in reviewing the options, your personal agent suggests you can surrender the policy for the cash value of almost $250,000, or another option would be to let the company give you a reduced paid up policy that would bring down the death benefit from $5 million to $530,000. Regrettably, the insurance carrier has strictly prohibited your agent from advising you that alternatively, you could sell your policy to a life settlement provider and receive $1.2 million in cash. So naturally, without this information, you go ahead and surrender the policy for the $249,000. And then you learn that you lost approximately $1 million due to the lack of disclosure. Would you feel the agent and carrier had breached his or her ethical and legal duties owed to you? Absolutely. So now here are some phases that we go through in the process. And the time frame can vary. It really, a lot of it comes from the slowness or quickness of your medical doctors or medical groups in providing the medical records, because this is medically underwritten. So step one is the evaluation, which we do to see if you qualify. We don't do any paperwork until we are fairly certain that you would qualify. The second step is, if you do qualify, we have an application filled out and submitted. And the application is really quite basic. It's your name, age of, date of birth, and who are your doctors, and just a few other details, very basic. Then we compile the paperwork. We receive the medical records and physician statements from all your doctors. We provide the illustrations on your policy, as well as a copy of your policy that you want to see if you can sell. And again, they show on our slide here that it takes up to 2 weeks or more. And sometimes it is very quick, but oftentimes it's more like a month. The fourth step is that the policy is then shipped to all the life settlement providers. There are many. And the ideal thing is to create, if possible, a bidding war between them, because that can get you more money for the policy. So, we do work with the #1 broker in the life settlement industry, and we do have a long-standing relationship with every life settlement provider. So you can be assured that the policy is receiving attention and the highest bids in a competent bidding procedure. So sometimes it's not a bidding procedure. Sometimes there's only one investor group that is offering to buy the policy. It all kind of depends on what they're building in their portfolio, what they already have. Because if you think about it, if they have thousands of policies that they bought and they don't know, even though from the health standpoint, they have actuarially predicted when the individual is going to pass on based on statistics and their physician records, that's still not 100% going to be correct, right? So this portfolio, they're wanting to make money. They're in business to make money. They're also in business to buy policies that are the most competitive that are out there. So the more competitive the policy is, for example, if it's a term policy that has a conversion privilege that has not been exercised but can be, they like that a lot. If it is a whole life policy, they like that because the premiums don't go up. In fact, the premiums can sometimes go away altogether. And you would see a larger offer in general for those types of policies. Sometimes a universal life, if it's been funded correctly, is a good buy for them. Some others, and I will tell you one that I did recently, the gentleman in his 60s has a lung condition that there's no cure for. And he's a part of different studies at hospitals, but there's no cure. And his life expectancy is under 10 years because of this. The challenge for the life settlement companies this was a term policy with 2 years left of the level term cost, and then the policy cost was going to go up quite a bit and continue to go up every year thereafter. What we found for this gentleman was a variation on this, where the company essentially loaned him $30,000 of a $200,000 death benefit policy. But this is a non-recourse loan. He never has to pay it back, nor does his family. The loan is at 16%. And if he dies within the next 5 years, his wife still gets a partial death benefit, but the life settlement company gets the remainder. If he lives beyond the time that they anticipate, the money, the $30,000 they got up front, they don't pay it back, but they get the remaining death benefit. So it was a win-win all around. They were tickled pink to get the $30,000 to enjoy life now. They could not, as retirees, afford that premium going up to thousands of dollars a month after the 2 years is up. So it can work very well. I had another gentleman who has cancer, but it's in remission right now. Had a term policy that, again, was going to go up in a couple of years, actually less than 2 years. The first offer he chose to turn down. The first offer was for $10,000. Keep in mind, he's been paying this premium almost 30 years. It's kind of disappointing to hear all you're going to get for a $200,000 policy is $10,000. However, the life settlement companies keep these out there for potential buyers for 365 days. So even though he turned it down, I knew that it was still out there in case a better bid came along. Well, 4 months later, a better bid did come along. So I called him and said, "Are you interested? Do you want to find out more about this new bid?" And he said, "Absolutely." So the new bid was for $15,000 and he took it. So I've seen everything from a couple of $1,000s to hundreds of thousands of dollars based on what type of policy and what the individual client's situation is or health is. Now, the fifth step, when we receive the offers and counter offers, these are things that we communicate ongoing with the policy owner and their representative if they have one, to initiate an offer letter. Because when an acceptance is reached, then there's a closing package which has to be notarized. It's generated and the escrow account is opened with the third party. So this takes a couple of days generally. Then the signed and dated documents are returned and the company reviews the package to establish that everything is meeting the funding conditions. This is another 3 to 5 business days. Then the second to last is the notification stage. The insurance policy ownership paperwork is countersigned and forwarded to the insurance company where they document the change of ownership and the change of beneficiary to the life settlement company. This is going to retire, well, I said it earlier, it usually takes a longer period of time because they stall. Usually we say it's between 5 and 15 days. And you know the old saying, the squeaky wheel gets the oil. I sometimes have to get on the phone with the client to the insurance carrier and say, what's the holdup? You know, you have everything. How long is this going to take? Until they get so irritated, they just do what they're supposed to do. But that's not always the way it is. I don't want to overstate that, but it is fairly common at this point. Finally, step 8, everything is recorded. The ownership and beneficiary has been transferred to the Viatical or life settlement company. The settlement funds are deposited into the policy owner's bank account through wire transfer. And this is going to take the final 1 to 3 days. So, you know, this communication step by step by step, which is the process of getting a life settlement to completion, the communication is so important, not only with the client policy holder, but with all parties involved. And it's going to make it efficient and as rewarding as possible. And you as the consumer, the more knowledgeable you are, the more pleased you're going to feel throughout the entire life settlement process that things are moving forward. So, you know, we do try to make the whole process from beginning to end as simple as easy as we can, but we always let people know that it can be sometimes a very long process. You know, that's why we've been labeled as the go-to life settlement company for all of a person's life settlement needs. Unlike some entities out there that advertise, they do charge a fee, something in the neighborhood of $800 was the last I knew. We don't charge a fee ever. And we like to educate people. As I said in the beginning, if you are not a person who has a need for this or an interest, you probably know someone who could use this information. It's always good to be educated. So who are the people that are buying the life insurance policies? They're known as institutional investors, and of course they're building portfolios by buying multiple policies, and the people they're buying from are in different situations. Some are fairly healthy, like the retiring business owner who just doesn't need the policy anymore. It's a very good policy, but they just no longer have a need. And these portfolios they're building are really attractive assets because it's going to provide them with excellent returns, probably something in the neighborhood of 8 to 10%, and it's safe. And lastly, because those insurance contracts are legal contracts, and whatever it says they're going to pay upon the passing of the person who's the insured, that is what is paid. There's no argument with that. That's a legal contract. So this is a stable investment. It's uncorrelated or tied to anything in the market, nothing to do with the political climate, the housing sector, COVID-19. I wasn't going to say that during this. We hear that term so much, unfortunately, now, but I think we're getting out of the swamp slowly but surely. But nothing else on the outside can interfere with this. So typically, the people who qualify, the best candidates in this example are anyone who's 70 or older, although it could be a person of any age. Sometimes a young person becomes ill or maybe a quadriplegic with other issues. There's no limit as far as age, but we typically see best candidates are 70 years old or older. Life expectancy of less than 20 years, and I will tell you, for the most attractive, it's less than 10 years. And here it says policy of 50,000 or more. In my time in working with life and viatical settlements, I've only had one exception made for a $40,000 policy where the gentleman was apparently very ill, but then it turned out after getting extensive tests at a teaching hospital, he was not as ill as they originally thought. So he was actually much more healthy and did not qualify. But if he had been a viatical case, as we were thinking in the beginning, that would have been an exception made. But usually it's over $100,000 that they'll look at. And any type of policy will work. Term life, universal life, whole life, or a combination of any of the above. So here's another case for an individual age 59 with pancreatic cancer. His policy is a $500,000 term policy. And now that it's at the end of the level premium paying period and there's no conversion privilege available at this point, that had passed. This is an illness that's devastating, and he couldn't afford to convert the policy anyhow. He just needed additional cash to live without the stress and to live with dignity. So his agent suggested in this case, before he went ahead and lapsed the policy, he investigate a life settlement. His life expectancy came in at 72 and 24 months. We got him a net offer of $320,000. That, of course, is a life-changing amount for a man and his family in this terrible circumstance. Much better than getting nothing. The second case we have here is a male age 75 in standard health, not bad health. His policy was $300,000 in term insurance, also at the end of the level premium paying period, no conversion privilege anymore. And he called his agent to drop it because he no longer needed the coverage. And the agent said, well, before you do, let's see if there's value in the secondary or life settlement market. And, we're making agents or financial advisors more and more aware of this. I'm teaching a variety of people, including financial advisors, that this is an option that they need to share, when they find a situation or this type of situation. So, he called and said, this is a long shot because the fellow is in standard health, but do you think there could be any value in this policy as a life settlement? This person's life expectancy came back at 180 months. And after an extensive search, we were able to get him $5,000. Well, he and his wife were thrilled because this is found money. He could not afford to keep the policy any longer, but better to get $5,000 than no money at all by just lapsing the policy. And here's another one, male age 77, female 76. This is a very large policy, universal life, survivorship. And they really didn't need as much insurance to pay their estate taxes. And they didn't like, paying the premiums. They were just going to surrender for the cash value of over $354,000. They weren't really optimistic about a life settlement because the agent didn't think a survivorship policy on two people was something they were looking for. But come to find out, there was an offer of over $555,000, which is $200,000 more than they would have gotten by just cashing in the policy or surrendering the policy. And this is where there were companies competing against each other for the policy. More and more, this is coming out as a viable alternative for people, as opposed to being not as much known in previous years. And that is the end of my presentation. I would be happy to answer any questions anyone might have, but I hopefully answered the questions. And that's all I'm going to say about that, Maureen.
All right, that was really informative though, Susan. I thank you so much. I mean, I think the presentation was really clear, particularly with the examples of how this particular situation could play out and really benefit somebody to be able to use those funds in a variety of different ways, whether they need care at home or whether they decide to use it to go into some sort of assisted living situation. So I think the possibilities with the money is kind of endless, the kinds of things that people could do. So we thank you very, very much. And could you just let people know how they can get in touch with you?
I popped out of the last slide. There is an email and phone number on the slide. My phone number is area code 352-613-0827. I'll just see if I can share that again right here. And that's my email. It's a bit of a mouthful, susan@theincomeforlifeteam.com. And always happy to share good information. And everybody have a great day.
Well, thank you again, Susan, very much for presenting to our friends and folks here with your key to senior living options. And I'm sure we'll have you back again for another presentation at a later date. But thanks so much for being with us today. We really appreciate it.
My pleasure. Have a great day.
You too. Take care. Thank you.
Bye-bye.
Bye.